All right, bringing on Tim Quas here. Welcome to the show, my friend. Glad to have you back on, and good to be with you. Welcome to the show.
Good to be with you. Good to see you.
All
Tim,
right.
how are you?
I better bring some energy, I guess. I'm well, thank you.
Good.
How about you guys?
Yeah, you're
What have
dealing
I
with Mitch
missed?
here. I drink my coffee in the morning. What can I say?
Well, you missed Twitter. You
Good for
missed
you.
Twitter.
Me
What a
too.
move here. Let's do a talk market structure here on Twitter, and see if there was any preemptive, look into something like this. How is it looking ahead? Because obviously Musk took a big stake here this morning. The stock is trading up 20% here, TWTR. So I want to see the market structure on Twitter.
Dun dun dun.
Do
You hear Dennis?
So
he wants Twitter.
So do you think he's going to buy it? Do you think he's just going to buy Twitter?
I was saying on a pullback, I might, but this is not a
right?
pullback.
He has the money, doesn't he?
Oh, yes, he does. It's a much bigger deal than Jeff Bezos buying the Washington Post.
Yeah.
But it's a much bigger transaction. But could he? Well, sure he could. He could. Yeah. So, Dennis, to answer the question, so we would call Twitter a short-term 10.
Oh.
So when a stock is at 10 and supply is falling, you can get some very nice moves. And these dips in the supply side, for those of you new to market structure, what I'm talking about is supply and demand. And so this is price, just closing price. Then the green part is an algorithm that measures demand. When you put the various demographics together that create demand for stocks, we normalize that to a 10-point scale. So when it's at 10, it's slamming against the ceiling. That doesn't mean it won't stop rising. Then you want to look at the supply side. That's short volume. Short volume is a 2009 measure created by FINRA that reflects the percentage of trading volume in a given issuer in the market or what have you that is coming from borrowed stock. And so the downtrend in supply and the fact that demand remains very strong at 10 can lift prices. It's the kind of thing we say you should trade late in the overall broad sentiment cycle, which is exactly where we are. So could this have predicted that kind of move? Not really, Dennis, but it's not surprising given the supply-demand equation that it could move the way that it did.
Yeah, because I'm just wondering, like, he's probably accumulated this over time. I mean, in the open market. So you wonder if, that would pick up something like that, hey, we've got some buyers in here and it's pushing the price higher and obviously showing up in your system. So it's just interesting. Yeah. It's an interesting thought.
Probably in here, where you see created stock. And what I mean by that is, believe it or not, folks, when there's a big buyer for stock in the U.S. equity market, generally speaking, brokers are going to create it. They're going to create currency for the party to consume, and then they'll have to square the books over time. So the fact that you have this period of about, call it a good 3 weeks, where there was an excess supply curve, that would have been a really good time to buy it too, because the price was down. Right during options expirations, that's often a time where big institutions will use the liquidity created by derivatives to build a position. And then the fact that now for about the same period of time, the supply has been below trend, that's probably where it occurred. I can't say absolutely, but that's what the data to me would suggest. Could you pick up on that? I don't know. It is the way that we think about it. If the broad market sentiment, Mitch, is 7.2 and falling, what should you trade? And traders, we're not after the Teddy Roosevelt. It's the man in the arena speech, the famous Teddy Roosevelt speech about it's not whether you're the victor. Whether you succeed or fail, it's that you got into the arena and got dusted up. Well, we don't necessarily want to do that as traders, right? We do want to just win. So you don't want to get all dusted up in the arena. So what do you trade late in the cycle for broad sentiment? And what I mean is this. Here's where sentiment was the last time, or back in January when the market declined. Then in February where it was when the market declined, and where it is now. There's a high probability, and I said this Wednesday last week with Spencer and team, that there's a very high probability that the market goes down. And son of a gun, the very next day, the Dow goes down 550 points. What's giving it support yet is the big drop on the supply side. We've had two big divots in supply, and that's supporting the market. But that's not a growth kind of market for stocks. So you have to be aware of that, traders, going into it. And what would you trade? Notice that my Benzinga April 4 portfolio has very nice demand and a very constrained supply. Well, those are the conditions that you want. And there are two things that you could trade under these conditions. You could trade the Dominion Resources, the ADPs that have very stable demand and falling supply. That's a good, safe place to be. By the way, utilities is the only sector left that shows rising demand. Everything else has peaked and falling demand, meaning it's cause and effect. We're kind of late in the cycle. Or you could trade the winds of the world. Which are late stage, they're late stage 10s. These are the kind of things that can give you a little more lift. You see that? So the demand is all the way at 10, but supply has dropped sharply. Well, that could give you some gains. Just realize that we're late in the cycle. I'm thinking much more right now about not burning capital in the market. I'm content to wait. We talk about that all the time, the amount of time that the market is up or down. But that's what I'm thinking about as Market Structure Monday commences anew.
Yeah, definitely. I've been noticing the utilities getting stronger, and that was one of the names that pointed out to me, Dominion.
Yep.
So definitely going to keep that one on the watch. I've been seeing that one starting to rise. A big leader in that one was SRE. I'm not sure if the supply is showing a dropping off on that one, but going to keep watch on utilities. And like you kind of mentioned, was this kind of just a big bear market rally that we're getting and we're starting coming back with kind of that supply dying off? It doesn't really show that the short interest is coming back in, but what do you see there overall?
Oh, it's such a subjective consideration, Mitch. I don't claim to know anything special about bull markets versus bear markets, or whether this is a bear market rally. There's a lot of that discussion that we're just getting the sort of bounce that you get when the market remains in a long-term sort of bear posture, a propensity to the downside. By the way, this is SRE. So yeah, Sempra has been just fabulous. If it's spent the whole time at 5 or better, that is a great stock to own, and you can just continue to own that until the demand equation deteriorates below 5. You're exactly right. That's the kind of thing to own when we don't know if it's a bear market rally or if the bull market is resuming. My opinion on this is that the momentum market ended in May last year, almost a year ago. That there are long cycles between a cause and then the effect created by that cause. It's very much like monetary policy. There is a delay. If we lower rates, the effect, the frothy effect of that develops over time. And about the time we think everything's great, it's probably beginning to deteriorate. And when the Fed lifts rates, as we move into this cycle where we're increasing interest rates, the ramifications from that are that the United States consumer is very dependent on home equity, on the value of a home, on the capacity to refinance a home and use that capital for consumption. That's what the Fed wants. I think you should be very clear-eyed as a participant in the U.S. equity markets and the U.S. economy about that relationship. It is by design. The Fed pushes rates down because the number one engine for fueling our consumption economy is home ownership and the associated consumption that comes with that feeds into Home Depot and Lowe's and all the things that we do. Well, as rates begin to rise, there will be a delayed effect from that, and it's probable that we run out of capacity to consume at the rate that we have. And so that's going to have some effect in the future. But traders, if you think about short-term supply and demand, you can take advantage of what the market gives you without being exposed to the big risks like that. You can't avoid them entirely, and I have long-term investments too. But from a trading standpoint, you sure can. That's what you want to do.
Now, one area that I did see a little bit of weakness last week was tech. And so can we return to the market highs without these kind of tech stocks leading the way?
No, of course not. We can't. It's a huge part of the market. It's a very simple answer. No, you can't. If we go look at the tech sector, 443 components. We've had a very nice stretch, really the first one of 2022, where there was excess demand above 5, and supply that was falling. Those conditions continue to exist, but no, it's not. When you consider that tech, in the tech sector, call it 26% of the market's come down a little bit. Communication services, you have to add that piece of the puzzle in. Tech that is in consumer discretionary, like Tesla. The tremendous reliance of the market on tech means that it's very difficult to have the kind of bull market that we had in 2020 to November of 2021 if tech isn't the leader. It doesn't mean we can't have good days. I don't, Dennis, you tell me, do you think there's a way for the market to resume marching higher to new highs sustainably without tech?
No. I mean, it's just too much of the index.
It's too obvious. Yeah, the big components.
I mean, you can look at the indexes and you can say that whole thing, like why, they held up better than some of the smaller caps or some of the smaller growth stuff. And I mean, it's just, you got those 5 stocks that are S&P. Yep. I mean, 500 stocks, but it's really 5 or 6 stocks that are driving the bus all the time.
Right.
Yeah.
Right.
What do you have in the spy for us, Tim? You got anything? Because it's, you had the Friday move, right?
Yep.
And with everything that happened last week, you made a new low for the week on Friday, and you were thinking, well, this is, we're really going to give some back. And then you just had that late day rally. I was just wondering, because to me, there's, some pretty clear levels jumping out from Friday, and I didn't know if that would be, what the SPY supply and demand looks like on your platform.
Well, so it was an unusual, yet again, to me, we've had our faces shoved into the facts of market structure in 2022. And I think it's gotten short shrift. But Friday was another great example. Well, Thursday and Friday both were good examples. The market was fine on Thursday, and then all of a sudden the bottom dropped out of it in the last hour. And it was.
When did we have you on? Was it Wednesday?
It was Wednesday.
Because I said in the market did get quasted. Remember?
we got
Remember that?
And I warned that it could get quasted.
You said something, and I go, well, we'll see if the market gets quasted.
What happened?
But you didn't say it was going to happen so late in the day.
Right,
is what the thing.
Right, that's the interesting thing, that these two days, Thursday and Friday, Friday the same way, except that the market was down. In fact, I was sending a note to the CFO of a public company about what was going on, and it was 5 minutes to the close, and all 3 broad measures were down. And I looked up, and the Dow's up 140 points. I mean, in the last 4 minutes. So, what causes that? And I would, I'll say, new month, new money. It's one of our core principles. We tell traders, be aware of the context. And there are 3 big things that matter in the month. The beginning of the month, when the money that both comes and goes, required minimum distributions from retirement funds, and then new money coming in, 401k contributions. We made a big contribution, by the way, to our 401k profit sharing plan. You have to get it done by the 15th. And I hate to blow off, it's a big chunk of money that goes in. Well, we did that. So who else did it? Are there other firms running 401ks that say, well, I guess we better deploy that? And it gets deployed around reference prices. Right? That money that is trying to track the averages, it wants the closing price, the reference price, and it gets jammed into the end, and it causes these crazy moves. So I think that's what happened. Looking at the patterns behind SPY, to answer your question, Joel, It was a very small pattern, though. Does that mean, if I compare that pattern to what we saw March 14th through the 21st around big index rebalances and quarterly options expirations, that was a big pattern. And there were big changes in hedges in certain sectors, industrials in particular, and industrials have underperformed. There was a colossal drop in the use of hedges on the 21st of March in industrials specifically. So does that mean people are hedging against the risk that the economy slows down? Could be. But here's where the data are. The data are at the top of the Ferris wheel arc. These are the data that tend to precede declines. Again, I'm not saying it's going to be sudden because we had this big drop in short volume. That's what gave the market this lift. It's the fact that there was a bunch of short covering. But that's not the thing that gives markets sustainable lift. If it begins to turn and supply continues to fall, we could see declines into April options expirations. Again, I'm not saying that's going to happen. I'm saying that there's a probability that it could occur.
One more. Well, I'm in the market for some new threads, and I like that shirt, man. I like blue. That is a nice shirt you got on there.
Australian,
Australian. Okay, I figured I can't afford that.
You see, Joe?
Okay.
He's always looking good, man.
I can't afford that stuff.
You need those imported threads, man.
Back to Joseph A. Banks if I can find one that hasn't closed in the area. Thanks, Tim.
Appreciate it, like always, Tim.
Good to see you guys.
Hey,
you bet.
We'll definitely keep up with it.
Okay.
And you guys that haven't done so before, definitely check out Market Structure Edge so you guys can get this data and understand exactly what Tim's looking at. Right? Thank you for coming on, Tim. We'll have you back.
Good to see you guys. Happy to do it. Thank you. By the way, I'm headed to the sea again. I'll be here for next
traveling, baby.
Next Market Structure Monday. I'll be here then, but we're headed to St. Martin, St. Bart's, Anguilla, April 12th, 13th, thereabouts. So
nice.
try to get rid of the gaunt white winter appearance. So I'm just giving you a heads up. So, but we'll see you next Market Structure Monday.
Hey, you trade on those mountains for a little beach time. Can't blame you, Tim.
Exactly. It's mud season up there. You don't want to be up in the mountains in April.
No.
You want to be in the sea. Yes.
Have a good one, Tim. Enjoy that trip.
You guys too.